If you hold a large stock position, chances are you've thought about borrowing against it. Maybe you need a down payment on a home, capital for a new venture, or just the flexibility to diversify into other investments. Most people's first instinct is a margin loan. The problem is that if your stock drops, you can get a margin call, which can force you to sell your shares at the worst possible time, triggering taxes and locking in losses. Our caller advance is designed to address those issues. It gives you liquidity with no margin calls, built-in downside protection, and no taxable event until you're ready. Let me show you how it works. You borrow against your appreciated stock through an agreement with a counterparty bank. The bank provides you with upfront cash, typically 70 to 90% of your stock's current market value. Because you haven't sold anything, no taxable event is triggered when you receive the advance. You get the cash, the bank holds your stock, and taxes are deferred. Here's where the collar comes in. Your contract has two price levels, and they each serve a purpose. The floor is essentially a put option. It gives you the right to sell your shares at a minimum price, no matter how far the stock falls. That's why there are no margin calls. The cap is a call option. It limits how much upside you keep above a certain price. Think of it as the cost for the protection. You trade some upside potential for downside protection and liquidity. Between the floor and the cap, you participate in the stock's movement normally. Think of it as a defined range, protected below, participating in the middle, and capped above. The rate is fixed for the full contract term, which can range from 1 to 5 years. No variable interest, no surprises. We run a blind auction across multiple banks on your behalf, creating competition that can result in better terms than going to any single bank directly. On your settlement date, you have options. You can deliver your shares to the bank, or you can repay the loan in cash and receive your shares back. If you settle with your stocks, the IRS considers this a deemed sale for tax purposes at the floor price. That means that you've had the use of the capital for the full contract term while deferring the tax consequences. Some investors use that window to plan around a more tax advantageous year. Others use it to offset gains with losses from other strategies. Either way, you're in control of the timing. The entry point can be as low as $1 million in stock value. Traditionally, structures like this require $10 million or more. These are significant financial decisions, and it's worth a conversation with your tax and financial advisors before deciding if a caller advance is right for you.